Between 1828 and 1881, the US railroad sector was the most dominant sector in the US stock market, making up nearly 63% of the market capitalization. With infrastructure spend increasing as a percentage of GDP for data centers, it frames the way that this decade could play out. With the most dominant sectors being AI and crypto, this could reflect and foreshadow what happened in the railroad sector when it took over 63% of the market cap. You can see that with Meta, Amazon, Google, Nvidia, Microsoft all increasing their quarterly capex, these big tech companies are positioning themselves with the research and development for this future of AI. And then you can see that the general administrative costs are starting to come down for Amazon, which means that they're starting to put less investment into people and more into automation, which they already have in their factories with the robots that move the parcels around the storage facilities. However, every trend and every investment opportunity is a function of the macro and the liquidity increasing. Warren Buffett is the oracle of Idaho for his ability to sense a shift in sentiment, fiscal policy, and overall frothiness in the market, which allows him to move to cash-based securities during heightened periods of greed and high-value assets when they are oversold. He has his very own indicator to detect bubbles, where the overall market cap of the US equities compared to GDP provides a ratio. This ratio is signaling an all-time high. However, though this ratio is currently at all-time highs, when adjusted for money supply growth, it has barely moved from the 2009 and not even halfway towards the bubble of the 2000s tech boom. So you can see that the money supply has increased so dramatically over the last 2 decades that this Warren Buffett indicator doesn't really take into account the excess amount of extra liquidity that's in the economy. Analysts project across the microphones at every opportunity any fear that they can, and you can see that with these bearish engulfing candles, they usually signal a top, but just look at how long they really last. This chart perfectly personifies the importance of being bullish in the long term and maintaining assets in the market regardless of corrections, as the bull market average is at 254% growth over a 31% loss in the bear market since 1949. The Mag 7 continues to dominate allocations within the S&P 500 index, which is important as it shows a common theme. AI is the sector that is propelling all of the growth. This can be viewed another way, as the net income growth of the top 10 companies is severely pulling away from the other 490 companies, signaling where all the growth is, AI. The hardest money ever before Bitcoin was gold, and it shines a light on the S&P 500 and its lack of material growth. It's traded sideways when valued in gold. And finally, after a 20% correction, the historical performance for the remaining quarters is usually very positive. And when you see that 20% correction in the spring, the summer months into the back end of the year is usually positive. Bull market tops never conform when the consensus think a certain way. So you have to be a contrarian, which is why when analysts think we are overvalued, we are most likely not. In this video, I want to go through a few charts to just discuss the importance of understanding the macro, the money supply, the importance of understanding the AI direction and how that's going to become the most encompassing theme within the sectors that are going to grow over the next 5 years. And then also just finish off with why it could all be relevant. So I hope you get some value from this. It gives me a chance to provide what I think about the macro and how I'm positioned for the next few years when it comes to the markets, regardless of weekly corrections that are expected and low volume trading days, which allows market manipulation to be extremely easy to carry out. So if you get value from macroeconomics, like, comment, subscribe, let's go. These next 4 charts keep me bullish for the rest of 2025 and into Q1 of 2026, because it shows me that the money supply will continue to grow and the fiscal policy will have to ease globally. So you can see that the government outlays and the government receipts, the outlays are totaling 630 billion and the receipts are totaling 338 billion, with a 291 billion deficit. The only way to pay back this deficit is to borrow and increase the money supply. The reverse repo, which is basically the Federal Reserve's piggy bank, is what they use to lend overnight to commercial banks and also remove liquidity from commercial banks. This is now drained, which means that they're unable to maneuver the way that they'd like to. So this is going to have to inflect up, which again means increasing the money supply. And the money supply, M2, is just the ease at which available cash is accessible. Money supply first hit 11 trillion in December 2013, and since then, it's doubled by 22 trillion in less than 12 years. the money supply is continuing to grow at a faster rate, which is why Warren Buffett's indicator of a top doesn't quite reflect the increasing excess money supply that's now in the system. And this shows that the bank credit and non-bank credit in the China economy is now starting to inflect upwards. And so that will lead to the two biggest economies starting to stimulate the economy with more money supply, the US and China, which always leads to risk assets growing over the next 2 quarters. This is a positive outlook. To continue to build on top of this outlook for the macro and the fiscal policy, you have the CPI, which is trending down. Shelter is one of the biggest components of the basket that makes up the CPI data, and therefore, with it having a 12-week lag, it's still not really hit the numbers. And this chart shows that rent prices are just absolutely dropping like a brick, which I believe will lead to a lower CPI, which means that the Fed have more room to cut rates. Charlie puts it perfectly. Stocks at all-time high, home prices all-time high, Bitcoin all-time high, gold all-time high, money supply all-time high, national debt all-time high, CPI inflation 4% per year since January 2020, 2x the Fed's target. However, the Fed will have to still cut interest rates next month, which shows that there are cracks forming in the system. Quick look at the seasonality on average. September is usually a devastating month, and it can happen really quickly at the start of the month. October can be the first half quite rough, and then by the second half it recovers. November and December are usually the most positive months of the year. These next 5 charts really help frame the context behind why I'm convinced the AI sector is yet to really hit a bubble, and how in the past, when you had the railroads reach 63% of the total US stock market, the tech sector during the internet.com boom in the 2000s, where there was a real bubble that formed, I feel that this AI sector has not yet come close to forming a bubble. And you can see that in this first chart, it really shows why the Magnificent Seven are so important to the US economy. 34.2% is how much of a weight they have within the S&P 500, which is 500 companies. But the net income is 26.6% of the total index, which means that these Magnificent Seven companies are contributing a quarter in the actual income that's going towards the S&P 500, which also reflects the income that's going into the US economy. This chart perfectly personifies for me why a sector can continue to grow and reach really high valuations, especially with its monopoly over an index. And we're not even close with the AI potential boom that we've got coming, because in 1881, 63% of the total market cap of US stock market was made up of just railroad companies. This capital expenditure chart really just shows how Amazon, Microsoft, Google, Meta are really starting to ramp up their R&D. These 4 companies are increasing their capex in order to survive, because they understand what's coming. They understand that they're going to need to become more efficient and more effective with AI. The infrastructure spend in the 1880s was railroads, which is why the S&P 500 was made up of mainly railroad companies. But then telecom in the 2020 period was only 1%. But now we have in 2025 AI data centers, which are starting to make up a growing, increasing percentage of the US GDP. And in this chart, you can see how the general and administrative costs are starting to reduce for Amazon. It's just a trend that I've seen. For the last 12 months, that has gone down by 1.6%. And then it was down by 10.2% between the quarters of 2023 to 2024. And so as you see this start to trend down, I feel that they're going to start to lean out their workforce. So how could it all be relevant? I feel it's important to understand the growing trends and where money is starting to position itself. Crypto and AI seems to be where these large institutions are starting to build positions. And so I want to be able to catch those trends before they really take off. And so for me, understanding the context that frames the bigger picture for why AI is not a bubble and how it can continue to grow and monopolize an even bigger percentage of the S&P 500 in terms of its weight within the S&P 500 helps me build confidence and understand whether I'm allocated sufficiently enough in the right sectors. So I just want to finish off with these 4 charts that really give me again confidence that the direction for the remaining months of 2025 are positive. You have this chart which looks at the copper to gold ratio and then also the ISM. The ISM along the bottom in purple has flatlined. The copper to gold ratio has also reached a bottom. And when these two mean revert up, it signals risk. And it's usually where the smart institutional investors like to position themselves, because the next move up into October, November, December is usually positive for risk assets. The commodity spot index year over year and the global financial conditions index smoothed over 10 months, both inflecting upwards, which bodes well for Bitcoin, which is a commodity. Where I believe we are at this point in the cycle, when you think about the Wall Street cheat sheet, the psychology of this cycle, I feel that we're in belief, moving towards thrill, and we still have euphoria. And so there are still 2 legs of this cycle left, and how long they take to play out is not exact science, but I believe that it will end in December or Q1 of 2026. But around October, November, December is where I'd like to start to get a bit more defensive and reduce risk in the portfolio. This final chart looks at global reserve currencies and how they've changed over time. For me, the most dominant currency that I've ever used is Bitcoin, but in my lifetime, it's always been the US dollar. I couldn't imagine other countries having that dominant currency, but they have in the past, from Portugal, Spain, the Netherlands, France, Britain. And it shows that these currencies can change and the dominance that they hold over the economy globally can change. And I believe that the future reserve currency will be Bitcoin. And therefore, again, it kind of factors into this AI crypto trend that's going to, I believe, continue to be very prevalent over the next 5 to 10 years. So if you got any value from this video, like, comment, subscribe. See you in the next one. Thank you very much.